And there you have it, your closing bell for July 26th. Let's take a look at how the major indices fared. They did pull back a little bit from their session lows, but still ending firmly in negative territory. The Dow there losing about 230 points there, about 0.7%. The S&P 500 losing more than 1% there, almost 46 points. And the tech-heavy Nasdaq way down the most today, down 220 points there, almost 2%. Well, let's break down some of this market action with our panel. Joining us now is Hank Smith, Head of Investment Strategy at Haverford Trust, and Huw Roberts, Quant Insight Head of Analytics. So, Huw, I'm going to start with you. Obviously, we're seeing the markets continuing to pull back as they are awaiting a lot of these decisions that are coming out this week from the Fed, from the GDP data as well. What are you keeping an eye on in terms of what the market's digesting right now?
Well, we're exclusively about macro. We have a series of models that look at all asset classes from a quantitative macro perspective. So it's a bunch of variables that capture economic fundamentals, growth, inflation. It captures measures of financial conditions, real yield, slope of the yield curve, and stuff that looks at risk appetite, VIX and stuff like that. And at the moment, our models, which have been trending lower for all US equity indices throughout 2022, have stabilized, but they haven't really bought into this rally that we've seen since mid-June time. It's been more a case that we're kind of bumping along the bottom. So as we go into the major event risk, whether it's the earnings coming out this week, whether it's the Fed decision, whether it's the potential for a technical recession with the quarterly GDP growth number on Thursday, really we're just waiting to see what the aggregate macro conditions do, because at the moment they're not signaling any reversal to the upside. So we're kind of viewing this pretty much as what has been a bear market rally and normal order being restored in the last session or two.
Hank, let's talk about earnings because we have Microsoft and we have Alphabet, Google out in just a minute here. Then we have Meta later this week, Apple, Amazon. Those top five big tech companies control so much of the S&P market cap. What are you looking for in some of these results?
Well, look, take Microsoft, for example, stock we've owned for over 15 years, but they have beaten expectations on the bottom line in 20 of the last 20 quarters, on the top line in 19 of the last 20 quarters. I think you're going to see some impact from the strength of the dollar. Clearly, any of these companies that have a lot of international exposure are going to have some of that impact. But we think their fundamental business and the fundamental business model is strong, and I think that's going to be demonstrated in this quarter. I don't think they're nearly as impacted by inflation, nor some of the supply chain disruptions that other tech companies have been.
All right, Hank and Huw, we need you guys to hold on real quick. We have Microsoft out with its earnings report. Dan Halley, what do you have?
That's right, Shauna. Microsoft with a miss here on their report. They missed on not just revenue, which came in at $51.9 billion versus estimates of $52.45 billion, but also on earnings per share, that came in at $2.23 versus $2.29 expected. I think the real big miss here, though, and something that people will certainly be talking about is the productivity and business processes. That came in at $14.4 billion versus expectations of $16.7 billion. And then its all-important intelligent cloud business, that came in with $20.9 billion in revenue versus $21.1 billion expected. Those are some big numbers from Microsoft, and those are the businesses that really have been propelling the company's share price for the past few years. So to see this miss, obviously, it doesn't bode well for the other competitors in the cloud space. We'll be waiting, obviously, for Amazon later this week, but that, is really a disappointing sign from Microsoft.
All right, Dan Halley there, tech reporter, with the surprising news on the miss on both the top and the bottom from Microsoft. Let's get back to our panel, Hank and Huw. And Huw, your reaction to the miss from Microsoft, in particular on the cloud aspect?
Well, I would defer to Hank on this particular question in the sense that I get the sense he's very much a bottom-up guy. He will know the minutiae of Microsoft earnings better than a quant macro shop that tends to come from the top down. I think probably the most interesting part was the last part of your report there, because from a pure macro perspective, most of the big tech stocks in the States are in macro regimes. It's not just about bottom-up and company fundamentals. Macro drivers are important as well. Our models have strong explanatory power. Most are close to macro fair value. Microsoft was pretty much in line with our model. The outlier was Amazon. So the point there about the potential ramifications for other cloud-based businesses like Amazon, if you've got poor company news coming on that basis and you've got a rich valuation from a macro perspective, that's not a great combination.
All right, we're also getting Google Alphabet earnings are crossing the wires. Jared Blickery has that for us. Jared.
That's right. We're seeing the stock up about 4% in after-hours trading, but we got a miss on both the top and bottom lines. I'll get to what I think is driving the stock higher in a second. Revenue ex-TAC, that came in at $57.47 billion. Estimate was for higher, $58.03 billion. And then regular revenue, $69.69 billion. The estimate was for higher, $70 billion. But it comes down to the Google advertising revenue. Now, that was a beat, $56.29 billion. The estimate was for a bit lower at $55.91 billion. So I guess all is well with search. They managed to step over that low bar. Now, other revenue, $6.5 billion versus the estimate of $7.11 billion. Services, $62.84 billion versus estimates of $62.89, so basically in line. And then the cloud, $6.28, small miss. The estimate was $6.32 billion. And EPS coming in at $1.21. The estimate was for 11 cents higher at $1.32. Operating margin, a bit light, 28%. The estimate was for 28.4%. Capital expenditures, a little bit less than estimated, so that could be some good news too. $6.83 billion versus estimate of $7.99 billion. And then the number of employees, and this is a lot, 174,014 versus the estimate of 168,454. So those numbers are going up as well. So is the stock up 4% in after-hours trading.
All right, thank you, Jared, there breaking that for us on Alphabet. I want to bring in our market panel here. Hank, I want to get your response. Obviously, a tale of two very different companies, looking at what happened with Microsoft and then obviously just now coming out with Google as well. What's your reaction to this? How expected was this, do you think?
Well, look, remember, we got a lot of weakness with Google after the Snap tremendous earnings disappointments. And so while they missed consensus expectations, it wasn't by that much. So I think there's a little bit of a relief rally there. You know, more broadly speaking, these tech companies were huge beneficiaries of the pandemic and the lockdown. And I think they're giving some of that back as we make a lot of adjustments from the dislocations that this global pandemic created. And it's still going to take several years. And the dislocations were in spending patterns. And, you know, we're seeing a lot less spending on goods. And, you know, you're looking at Walmart as an example there that you brought up earlier, and much more spending in services and experiences that we couldn't do for the better part of 2 years. So, and now throw in supply chain. I think there's just a lot of normalization that still needs to occur. And then you throw in inflation on top of that. And so, you know, you have a narrative that is changing almost every single week, whereas for the better part of a year and a half to the end of 21, the narrative was exactly the same in the market. And hence the volatility we're experiencing with this almost weekly change in narrative throughout 2022.
All right, Hank Smith of Haverford Trust, Head of Investment Strategy, and Huw Roberts, Quant Insight, Head of Analytics. Thank you to you both for joining us this afternoon.